In 2020, there was around $240 billion spent on mobile ads alone, and the majority of that went to two companies. Now you can probably guess those companies being Facebook and Google, two companies that are just trying to take over the world. But the $50 billion is kind of up for grabs. In this video, we're talking about a mid-cap company that's growing at a pretty fast pace that's in the mobile ad space, and that's Digital Turbine. So we're gonna be talking about the stock, the company a little bit. They've been on a buying spree of smaller companies and have kind of created a one-stop shop for advertising on mobile. And so Digital Turbine can take advantage of the expected increase in mobile ad spending over the coming years, as that 50 billion piece should grow along with the total addressable market. All right, so how does this company get a piece of this $340 billion in 2021 ad spend? Well, from the moment that someone opens their phone, there can be pre-downloaded information either from the telecommunication company or another advertiser. And then through recent acquisitions, through Fiber and Ad Colony, these are more advertising exchanges and marketplaces where advertisers and publishers kind of meet and they buy ad space. And then you have Appreciate, which is the demand side of programmable advertising. So this is where advertisers go on and buy ad space automatically. So through these different platforms, as well as their original software, this is kind of how the company gets a piece of this $340 billion. So this company is going for network effects because as more devices have the initial Ignite platform installed on it, all of a sudden there's also an easier way to implement all these new acquired companies. So more new products, and then over time, more advertising demand equals basically more money and more profit for this company. So we can see that currently there's 600 million total devices that have the Ignite platform installed. And then the company is also basically saying that the market share that they have is continuing to grow, and there's possible situations where they can expand into different things other than smartphones, such as smart TVs, also wearables. As of this video, Digital Turbine trades around $64 per share, and 2020 was the year of explosive growth, and it went from middle single digits all the way up to 100 at the beginning of the year, but it's had a bit of a pullback, which I think is a little bit expected as it was probably a little overheated at the beginning of the year, but the company is still growing at a very fast pace. So these pullbacks is kind of when I take a look at these high growth stocks that could potentially have pulled back to closer to something to fair value. And the reason it's important to talk about all these acquisitions and how the company is kind of looking now versus literally a couple of quarters ago is because if you looked at the financials and looked at the revenue and didn't know all that backstory, you'd be scratching your head saying, how do they go from 95 million to 212 in one quarter? Well, it's because they went from kind of one business to 4 different separate businesses now in one platform. Because if you read the second quarterly earnings, we see that the acquisition of Ad Colony and Fiber didn't even complete until the second quarter of this year. So their latest earnings was actually their first quarter fiscal 2022 year, because their fiscal year ends in March. But we see that the revenues, don't even include the full quarter for those companies. So this 212 doesn't include the full quarters of Fiber as well as Ad Colony, but the 292 million pro forma, what they mean by pro forma when you see this means, okay, we're going to pretend that these companies have always been together. That way we can see a true comparison year over year. With that factored in, you go from 259% yearly growth to 104, which 104% year over year growth is still pretty solid. And we can see that it's mostly coming from Fiber. That's growing at 200%. So that is an insane year over year jump in quarterly revenues, but pretty much across the board, everything is growing. Ad Colony is the slowest grower at 46%, which I don't think anyone would complain about 46% increase in revenues year over year. That's why if you look at a website like Finbox and you see this revenue percentage of 64.6%, it makes sense because from fiscal year 2021 to 2022, there is an explosion in revenue growth. And that's mostly because a lot of these companies that weren't together before are now formed under one umbrella, Digital Turbine. So in future quarters, unfortunately, probably won't see 100% revenue growth year over year, but the expectation is still pretty high, around 30 to 40% for the upcoming years, which is what I use for my valuation. Now, if you're anything like me, you're wondering, where the heck is this company finding all this cash to be buying these companies? Well, it's not all funded with cash, and that's why we we can look at the balance sheet to see kind of did they use debt, did they use shares. With Fiverr, they paid $600 million for the business, $150 million of that was in cash, and then $400 million was paid in Digital Turbine shares. So in a way, they're diluting the shareholders in order to buy these companies. As for AdColony, that was valued at around $400 million. One downside with all these acquisitions and them kind of going on this buying spree is that they're lower on cash, and they did have to raise a little bit of debt. So I think that's to give themselves a little bit of a cushion just in case if they have a couple bad quarters or something like that. I mean, the company did turn a profit of $14 million on all those revenues that we were talking about, and they are generating free cash flow, which is good to see. So realistically, so as long as they can keep that up, there probably won't be any issues. But currently they have, $83 million in cash on hand and then $233 million in long-term debt. And overall, the current ratio being below 1 just means that they don't have really good liquidity, but they could always raise more debt. And right now, with rates being so low, probably not the worst time, so they could lever up even more. But I'm not saying they even have to do that. It just would be if they had some bad quarters and had to raise additional debt. The company also gave guidance of expected revenue and earnings for next quarter. So with that information, factor that into the valuation as well, and also to get an idea of what the combined company would look like for net profit margin and use that in the valuation. So something like 40 million net income off to 300 million, that would be around 13%. So I went ahead and used that and then use kind of an incremental build in their operating efficiency over time to slightly increase their profitability. When I use Finbox and kind of estimates for revenue growth of 25% after 2022, as well as an increase in operating margin over time, as well as these assumptions up here, I come up with a fair value of around $61.63, but then also factoring in something like a price of sales, a multiple of 10, which is kind of the historical range that it's traded in. This is more around $48.68. So a blended number would be around $57.31 for the fair value. As for an estimate of around where I think it could be in 2023 based on a price sales multiple of 6, and the reason I lowered it is because the 10 is factoring in much higher growth rates, whereas the 6 is maybe something more reasonable for something growing at 25 to 30% for the next 5 years. So at that point, that's kind of the price to sales ratio I would more expect. So realistically, end of fiscal 2023 would be $95.65. And if you're wondering what it would be on an annualized basis, that would be around 36%. So if we take a look at where it was trading at the beginning of the year, around $100 per share, that was probably a little overhyped on the growth expectations, because remember, it's not going to be growing 100% every year forever. It's probably going to cool off, but that doesn't mean the 30% revenue growth can be ignored, right? That's still a pretty high growth rate. The company is expected to be profitable, and this is kind of the company that I'm looking for that could potentially grow over time at a pretty good pace just because of the size of the company as well. It's a mid-cap company, so they're growing revenues, they're profitable, and it's a smaller company that can grow into a much larger valuation as the total addressable market for mobile ad spend continues to go up year over year. As for risks and opportunities, I see the biggest risk in a slowdown in ad spending, specifically in the mobile area, because this company is so concentrated in one niche. That would be obviously a risk. As for opportunities, they could expand into different markets. So right now, most of the focus is on smartphones and the mobile device. Whereas if the company does get into wearables as well as smart TVs, they could expand their reach and also their total addressable market. Also, I would like to complain to the stock gods really quick, because when I was doing the deep dive in this company, of course, it's announced that they're included in the S&P 500 mid-cap fund, and the thing shoots up 20%. So it kind of sucks, couldn't accumulate in the lower 50s, but it is what it is. Who knows? Maybe we get lucky and there's a gap fill back down to like that $52, $53 area. If you did enjoy this video, make sure to hit that like button and consider subscribing to Main Street Wolf, where we talk investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.